Have you ever wished you could personalize your investments instead of just buying into a standard index fund? That's where direct indexing comes into the picture. This is a powerful strategy that lets you build your own version of the S&P 500. Now, of course, the S&P 500 tracks 500 of the largest companies in the US. Traditional index funds or ETFs that follow the S&P 500, they simply just buy all the stocks in the index according to their weights. But direct indexing allows you to own the individual stocks in the index yourself, giving you more control over your portfolio. So how does direct indexing differ from traditional index funds? Well, with direct indexing, you're not buying shares of a fund or an ETF. Instead, you purchase each stock in the index directly in the proportions that match the index. And that means you can tailor your investments based on your specific goals, values, or financial situation. For example, you may want to exclude certain companies or sectors you don't want to invest in, like maybe those that don't align with your values, or maybe that you just believe have less growth potential. You can also increase exposure to stocks you think are poised for growth. So you're not necessarily required to mimic the index exactly. Now, one of the biggest benefits of direct indexing is the ability to tax loss harvest. What that means is when individual stocks in your portfolio decline in value, you can sell them to realize a loss, which can then offset capital gains elsewhere, potentially reducing your overall tax bill. So let's say that you have a direct indexing portfolio that replicates the S&P. Some of the stocks you hold are Apple, Microsoft, Amazon, and Tesla. Now imagine that it's late in the year and Tesla, we'll just use that as an example, has experienced a significant decline. Say it's down 20% since you bought it. Meanwhile, Apple and Microsoft have appreciated substantially, and that's generated a large unrealized capital gain. So here's how tax loss harvesting would work in that situation. You sell the losing stock. So you decide to sell your Tesla shares to realize a capital loss. Now, suppose your initial investment in Tesla was $10,000. After the 20% drop, the stock is now worth $8,000. So selling those shares allows you to realize a $2,000 capital loss. Second, you offset the capital gains. That $2,000 loss can be used to offset $2,000 worth of capital gains elsewhere, such as those gains you had in Apple or Microsoft. 3, that reduces your tax bill. By lowering your net capital gains, you reduce the amount of tax you need to pay on those gains. 4, you reinvest in a similar stock to maintain your portfolio's alignment with the S&P, at least as closely as possible. You could use the proceeds from the sale of Tesla to buy another stock in the sector, or wait 31 days to avoid the IRS wash sale rule, and then you repurchase Tesla. So this keeps your investment exposure relatively constant while taking advantage of the tax benefit. By strategically selling stocks that have declined in value, you can reduce your overall capital gains tax, effectively lowering your tax bill while still maintaining a diversified portfolio. Keep in mind, direct indexing isn't for everyone. It can require a larger initial investment and might involve more time and effort to manage. And if you're working with a financial advisor, they can help determine if this strategy fits your needs.